Good day, investors. Welcome to Investing Iguana. The Investing Iguana is featured and ranked 8th in the 2023 Influential Tigers by Tiger Brokers. In this video, we're conducting a comprehensive analysis of CapitaLand Investments' FY23 financial results. I am Iggy, your guide through the critical figures and strategic implications these results hold. Our focus will be on interpreting CapitaLand's financial health and operational direction, essential insights for any serious investor. We will review 8 of the key slides and give a detailed interpretation and analysis for you. We will examine whether CapitaLand's recent performance reflects a trajectory towards growth or if emerging challenges could potentially disrupt their progress. Let's begin our in-depth evaluation of CapitaLand's financial outcomes. Slide 01. This opening slide highlights the financial overview of CapitaLand, a leading global real asset manager with a strong focus on the Asian market as of December 31, 2023. CapitaLand boasts a substantial real estate asset management portfolio valued at $134 billion, with a significant market capitalization of $16 billion on the Singapore Stock Exchange, indicating its substantial footprint in the industry and investor confidence in its operations. The company manages an impressive $100 billion in funds, oversees 6 listed REITs and business trusts, and operates more than 30 private vehicles, which underscores its diverse investment platforms and the breadth of its asset management capabilities. CapitaLand's global presence is extensive, with operations in over 260 cities across more than 40 countries, and with over 90% of its real estate assets located in Asia, it demonstrates a deep market penetration in the region. The financial metrics for FY 2023 reveal a slight decrease in revenue from $2,876 million in FY 2022 to $2,784 million in FY 2023, and a more significant reduction in operating PATMI from $609 million to $568 million for the same periods. The total PATMI also saw a decrease from $861 million in FY 2022 to $181 million in FY 2023. These contractions may indicate operational challenges or market headwinds that impacted the company's profitability within the fiscal year. Despite this, CapitaLand has a strong liquidity position, with group cash and undrawn facilities at $6.4 billion, up from $5.9 billion in FY 2022. Additionally, the company has a healthy capital recycling initiative, netting $2.1 billion in FY 2023, although this is lower than the $3.1 billion in FY 2022. CapitaLand's net debt-to-equity ratio is relatively modest at 0.56 times in FY 2023, marginally up from 0.52 times in FY 2022, which may be an indicator of sound financial leverage. From an investment analysis perspective, CapitaLand's strong presence in high-growth Asian markets, coupled with its robust liquidity and modest leverage, positions it as a potentially resilient player in the real asset management space. However, the decline in profitability metrics will require a closer look to understand the underlying factors, as they could impact future earnings and investment attractiveness. Potential investors may be interested in CapitaLand's strategic initiatives to mitigate revenue and PATMI declines and how these strategies could drive growth in the coming fiscal years. Slide 02. This slide presents a comprehensive view of a diversified real estate company's business model, focusing on an integrated ecosystem designed to drive fee income growth through various product verticals, leveraging a strong global real estate portfolio and specialized local teams. At the heart of this business model lies the division of the company's operations into 4 main segments, each catering to different market needs and collectively contributing to a robust income-related business, FIB. The private funds management sector, with funds under management, FUM, of $39 billion, demonstrates a significant commitment to growth with an Asia-Pacific focus. This suggests a strategic emphasis on the APAC region, which is known for its dynamic real estate market and potential high growth rates. The listed funds management arm, boasting $61 billion in FUM and status as APAC's largest REIT manager by market cap, indicates a dominant position in the region's REIT market, potentially offering investors stability and expertise in listed real estate investments. The investment property segment includes $8.68 billion of pipeline assets on the balance sheet, showing the company's future growth prospects and commitment to expanding its asset base through disciplined capital recycling. The lodging management vertical, overseeing approximately 165,000 units with a target of over $500 million in fee-related earnings, FRE, by 2028, underlines ambitious growth plans and a sizable operational scale in the hospitality sector. Meanwhile, the commercial management segment's control over more than 240 properties across significant markets like Singapore, China, and India, covering over 21 million square meters in gross floor area, GFA, highlights the company's extensive operational reach and expertise in commercial real estate. Lastly, the emphasis on aligning interests with capital partners and unit holders through stakes in CLI fund vehicles suggests a strategic approach to maintain investor confidence and ensure the long-term sustainability of the business model. From an investment perspective, the company's diverse portfolio and regional focus, particularly in high-growth Asian markets, coupled with a strong pipeline for growth and significant assets under management, make it an intriguing prospect for investors seeking exposure to the real estate sector. The company's strategic initiatives aimed at increasing fee-related earnings and its alignment with stakeholders' interests could offer potential for stable and growing returns. Slide 03. From this slide, CapitaLand stands out as a significant player in the Asia-Pacific region, holding the title of the largest REIT manager by market capitalization, a hefty sum of 34 billion Singapore dollars across its 6 REITs and business trusts. This signifies CapitaLand's substantial influence and presence in the real estate investment trust market, reflecting investor confidence and a strong track record. The diversified portfolio of CapitaLand spans both developed and emerging markets, indicating a strategic balance between stability and growth. Its asset classes are well distributed, with the largest S-REIT under its management boasting a market capitalization of 13.7 billion Singapore dollars and a fund under management, FUM, of 24.3 billion Singapore dollars, emphasizing the trust's substantial presence in the commercial sector, specifically retail and office spaces in Singapore. The image also showcases CapitaLand's focus on emerging markets, with significant investments in China and India, which include retail, business parks, and logistics parks. This geographic and sector diversification is likely intended to capture growth in burgeoning markets and hedge against the cyclical nature of real estate in more developed economies. From an investment perspective, the company's expansive reach across diverse markets and asset types may appeal to investors looking for a blend of stability and exposure to growth. The commitment to both global developed markets and dynamic emerging markets suggests a nuanced understanding of the real estate landscape, which could be beneficial in navigating through economic cycles. The robust market capitalization figures, coupled with the substantial FUM across its portfolio, indicate a strong and potentially resilient investment opportunity. Investors interested in CapitaLand should consider the potential of its diversified portfolio, which is geared to capitalize on the growth of emerging markets while maintaining a strong foundation in developed regions. The company's comprehensive approach to real estate investment, combined with its significant market presence, sets a solid foundation for potential growth and resilience against market volatilities. Slide 04. The financial performance of a company for a given fiscal year can often be a strong indicator of its health and potential for future growth. In the case presented, the FY 2023 performance has been notably impacted by macroeconomic challenges. The cash PATMI, profit after tax and minority interests, of 781 million Singapore dollars, though reflecting a slight 6% year-over-year decline, is supported by strong recurring income. This suggests that the company's operations have a stable income-generating base. However, the total PATMI shows a significant drop of 79% from the previous year, which the company attributes to non-cash fair value losses. This large discrepancy between cash PATMI and total PATMI indicates that while the company's operations are generating cash, the value of its assets has decreased, likely due to adverse market valuations or reassessments of asset values in response to market conditions. The funds under management, FUM, have grown to 100 billion Singapore dollars, which is an increase of 4 billion Singapore dollars from the previous period. This includes about 10 billion Singapore dollars of funds ready for deployment, highlighting the company's capacity for strategic investments and growth initiatives. Moreover, the net debt-to-equity ratio has marginally increased to 0.56x, which still reflects a strong balance sheet with significant headroom for potential acquisitions. Despite increased implied interest costs, which rose by 80 basis points to 3.9% and have offset some property-level performance gains, the company has proposed a stable dividend, underlining the strength of its operating cash flow. The fact that the company can maintain a stable dividend in the face of rising interest costs is a testament to its ability to manage cash flow effectively. From an investment standpoint, the strength in fee income-related businesses and the outperformance of the lodging management segment are promising signs. Additionally, the solid performance in Singapore and India helps balance the softness in China's operations. The increase in FUM and a reasonable net debt-to-equity ratio suggest that the company is well-positioned to take advantage of growth opportunities, even in a challenging macroeconomic environment. Investors should consider both the resilience of the company's recurring income streams and the impact of macroeconomic factors on asset valuations. The proposed stable dividend also indicates a commitment to returning value to shareholders, which may be attractive to income-focused investors. However, the decrease in total PATMI warrants attention to understand the long-term implications of the non-cash fair value adjustments on the company's financial health. Slide 05. This slide provides a detailed breakdown of the factors affecting FY 2023 total PATMI for a company, which appears to have encountered several headwinds. Firstly, operating PATMI saw a 7% year-over-year decrease. This was a result of stable performance in the fee income-related business, FRB, segment being offset by a decline in the real estate investment business, REIB, attributed to higher interest costs and challenges in the Chinese market. The stability in FRB is a positive sign, indicating a reliable and potentially growing stream of fee income. However, the decline in REIB warrants attention as it may reflect broader market conditions or sector-specific issues that could impact future profitability. Portfolio gains decreased by 4%, signaling a drop in divestment value. This could suggest either a strategic shift in the company's asset management approach or a response to less favorable market conditions for asset sales. However, the fact that the average divestment premium rose implies the company was able to extract greater value from fewer sales, which could be seen as a demonstration of effective asset management. The most significant impact comes from a substantial 630 million Singapore dollars year-over-year decrease due to revaluation/impairment, indicating non-cash fair value losses predominantly in China and the USA. This points to a marked depreciation in asset values in these markets, which could be due to a variety of factors including economic slowdowns, policy changes, or shifts in investor sentiment. While the total PATMI shows a stark 79% reduction, the fact that cash PATMI has remained largely stable is crucial. It suggests that the company's day-to-day operations and cash-generating ability remain solid, a factor that can be reassuring for investors who may be concerned about the company's operational health amidst asset value fluctuations. For potential investors or current shareholders, these insights can serve as a basis for a more nuanced understanding of the company's financial performance. While the headline figures suggest a challenging year, the underlying cash flows remain robust, indicating that the company's core business operations have not been fundamentally compromised. However, the significant fair value losses could impact the perceived growth trajectory and asset strength of the company, which would be an important consideration for investment decisions. Investors would benefit from further analysis into the causes of the revaluation losses and the company's strategy for navigating them. Slide 06. As an investment analyst looking at the provided image, it appears that the valuation of a certain company's assets has been significantly affected by the current macroeconomic environment. Specifically, the company has experienced a considerable fair value loss largely emanating from its China operations, which faced a $511 million valuation decrease. This is mainly attributed to weaker rents and a less favorable market outlook. Additionally, the U.S. market has also contributed to the fair value loss, with a $213 million decrease, mainly due to capitalization rate expansion, which typically indicates investors are requiring a higher return on investment. On the other hand, the company's operations in Singapore and India have presented a brighter picture, with gains totaling $209 million. These gains have been instrumental in partially offsetting the fair value losses encountered in other markets. The Singapore market, in particular, has seen a fair value gain of $165 million from a variety of asset types including retail, integrated developments, and business park/logistics/industrial properties. This suggests a robust performance in these sectors within the Singapore market. For the readers interested in the stock of this company, the information suggests a nuanced picture. The significant fair value losses in China and the U.S. point to the impact of challenging economic conditions and potential market-specific headwinds. However, the gains in Singapore and India reflect strong market positions and potential growth in these regions, which may indicate areas of resilience within the company's portfolio. Investors would need to weigh the regional variances in performance and consider how these might affect the company's overall financial health and future earnings potential. The mitigation of losses through gains in specific markets also indicates a diversification benefit within the company's asset portfolio, which can be a valuable strategy in managing global real estate market volatility. Slide 07. When evaluating the EBITDA, earnings before interest, taxes, depreciation, and amortization, performance for FY 2023 as presented in the slide, we can discern the operational strengths and weaknesses of the business under review. The total EBITDA stands at 1,104 million Singapore dollars, which marks a slight decrease from the previous year's 1,966 million Singapore dollars. This decline may raise questions about the company's operational efficiency or market conditions over the fiscal year. Looking at the breakdown by business, we see that fee income-related businesses, FRB, have a relatively stable EBITDA year-over-year, indicating consistent performance in revenue-generating activities that do not directly relate to property investments. The real estate investment business, REIB, operating EBITDA also remains stable, which suggests the core property investments continue to perform reliably. However, there is a notable non-operating loss, which could be due to one-off items or events not part of the company's regular business activities, and this has contributed significantly to the overall decrease in EBITDA. Geographically, the EBITDA from Singapore and other developed markets remains robust, showing that the company's operations in these regions are resilient. The negative EBITDA from China, however, is a cause for concern and reflects the challenges faced in the Chinese market, which could be due to economic headwinds or competitive pressures. From the asset class perspective, the lodging sector contributes a whopping 60% of EBITDA, underscoring this segment's importance to the company's profitability. The retail and office segments show a decrease in EBITDA, possibly due to the market trends impacting these sectors, with the retail industry potentially facing long-term challenges due to e-commerce growth and changes in consumer behavior. For readers interested in the stock, the stability in FRB and REIB operating EBITDA is reassuring, indicating that the company's primary business engines are still performing well. The geographical data suggests that while there may be regional challenges, particularly in China, the company's diversified presence provides a buffer against localized downturns. The heavy reliance on the lodging sector for EBITDA may be seen as both a strength and a potential risk if the sector faces downturns. Investors would be wise to consider the company's strategies for addressing non-operating losses and regional challenges when making investment decisions. Slide 08. Analyzing the company's strategic plan as depicted in the slide, it's clear that they are poised to navigate through current market challenges with a focused growth strategy. The company intends to actively engage in capital recycling, which involves divesting assets, particularly in China and the USA, and reallocating resources to more promising opportunities. This not only allows for portfolio optimization but also reflects a strategic shift that could potentially reduce exposure to adverse market conditions in those regions. The company's aim to strengthen its balance sheet and target a new funds under management (FUM) goal of 200 billion Singapore dollars in the next 5 years is ambitious and indicates a forward-looking growth perspective. The focus on scaling in specific sectors such as lodging, logistics, and self-storage is also noteworthy. These sectors, especially logistics and self-storage, have seen global demand surge, possibly accelerated by shifts in consumer behavior and e-commerce growth. By establishing a track record in these areas and accelerating growth momentum in listed funds, the company is looking to enhance its market position and capitalize on these trends. Furthermore, the company plans to harness geographic tailwinds by doubling down on investments in India and Southeast Asia, regions that have been showing robust economic growth and investment potential. The strategy to optimize the portfolio in China and expand renminbi-denominated funds could help in mitigating risks and capturing the upside in the evolving Chinese market. Additionally, expanding fund product offerings in Japan, South Korea, and Australia represents a diversification strategy aimed at tapping into the growth potential of these developed markets. For investors interested in the stock, this strategy could suggest a proactive approach to managing current headwinds while positioning for future growth. The focus on sectors with rising demand and geographical diversification can be seen as a move to build resilience and tap into new revenue streams. Investors might find the company's clear strategic objectives and target benchmarks, such as the new FUM goal, indicative of a well-defined roadmap for growth. However, as with any investment, potential risks such as execution challenges and market volatility should be carefully weighed. And that's a wrap on our analysis of CapitaLand Investments FY23 results. We've traveled through their financial statements, unpacked their strategic initiatives, and explored the potential impacts on your investment decisions. Remember, understanding the story behind the numbers is what sets apart the savvy investors from the rest. If you enjoyed this breakdown and found value in our discussion today, please show your support by hitting that like button. It really helps the channel. And if you haven't already, make sure to subscribe and turn on notifications to join our community of informed investors. Got thoughts or questions about CapitaLand's results? Drop a comment below. I'd love to hear your perspectives. Until next time, this is Iggy from Investing Iguana, reminding you to invest wisely, stay curious, and keep crunching those numbers. See you in the next video.